Welcome back. Like I mentioned last time, we'll start diving into a couple of the indicators that I see more commonly used and more simple to start with. The first one is the moving average. This indicator is used really to kind of smooth out the price and really the movement of the price up and down. It's in simple, it's really the average of the price over a period of time. So, if you're looking at last 5 periods, if it's days, if it's hours, you take each price and then the average. The intent is to help you figure out a way to see how the price is moving to help you figure out an entry and an exit. Now, with this indicator, there are certain elements that need to be basically there. First, there needs to be some sort of a rhythm to the price, right? A trend. It needs to be going in a direction. And then after that, it needs to be respecting that direction. So what we're gonna do is we're gonna dive into a chart and start basically looking at an example that I've picked up that I think makes sense. In terms of the indicator, people use the moving average in different ways. The most common ways I've seen through what I've looked at so far are, on day-to-day trading, a lot of people use a smaller time frame, like a 9-day moving average. Also, a 20-day and a 50-day and a 200-day are used. Usually it's because 20-day represents kind of a month, 20 business days, a month of trading. 50 is like 2 months, and 200 is like a quarter. So depending on where you're looking at, depending on how you trade, you may be using some of those differently. Of course, the longer the period, the longer the span, is the easier to identify basically the entry. A 9-day would be something shorter, so the movement is definitely much quicker versus a 20 or a 50. So with that, let's dive into a small example and we'll dive into a little bit more. So this is basically SPY. This is basically an indicator, a market indicator here. One of the things to look at is, like I mentioned, first you want to see, is there any sort of movement? Like, is there something you can see? Is it moving up? Is it moving down? The best way to do that is, depending on where you're at, because if you're in too close, it's not very easy. You see, it's not easy to identify. But if you zoom out, I find it makes it a lot clearer. So if I zoom out here, now I'm looking kind of like at a 2-year span. I can see a movement in a direction. You see, like if I plot here, there is a movement up. So the important thing is that there's some sort of a trend. Up or down, the important thing is there's a trend. Second, now what you want to do is, if you go into here and then you add your moving indicator, moving average, like I mentioned, there's many different time frames. You see here the 9-day, you see how it's so close to the price because it's such a short period of time. And then if you go a little bit further out, the 50 starts to basically create a little bit more space, and then the 200, even more. So this, the time, the length that you want to use for the moving average depends on how you are trading. If you're starting off, you see that the 200 really just to kind of tell you a path, but it's very difficult to figure out more of a strategy. The 9 may be a bit more challenging, but the 50, what I find, is a little bit more forgiving because you can tell when it gets close, you can tell when it moves off it. So now that we have we've looked at basically, the trend. Now we'll start to look at basically how do people use it in terms of trading. In short, this is used to help traders figure out a way in when to buy, when to sell. And one common way to do that is to look at how does the price react when it gets close to the moving average. Is there a pattern? If you see here, there's an up, down. Let's just do this. There's a movement up, and then a movement down, and then a bit of a down, and then an up and a down. So this is the intent, to see, is there something happening that you can use to set a strategy. I would say most of the time, if I look at it, one of the important things is, one, is there a pattern and is there a trend? So we've already established, yes, there's a trend for this one, it's moving up. Is there a pattern? We do see, every time it comes close to the 50, it somehow moves up, and then it'll get close. Now sometimes it goes below, but it'll move up, and then it gets close, and then it moves up. So there is a pattern. So then what you do is you basically, depending on where you're at, now this is a bit historical, but if we were just to kind of look into here, let's just say, you're right here. Let's just say you're right here now. The price is here. You already see, okay, over the last several times, it's touched it and moved up, touched it, moved up, touched it, moved up. So you've kind of established that, it has created that rhythm a couple of times. And with that, you become a little bit more comfortable that, this could repeat the rhythm. So at the big picture, what you then tend to look at is, okay, knowing that it's going to come when it gets close, it's going to push up. Then basically what you'll do is, if you're just starting off and you want to trade long, you wait for it to come down, and then you place your entry and you wait for a confirmation that it's going to go up, and then you look for an exit point. Now, I will have another video that will talk more about entry and exit, because of course those are a little bit more complicated, because just because it comes down doesn't necessarily mean that automatically it's going to go up, right? You have to first figure out that there's some indicator that gives you a sense that, hey, something's going on. If we look at here, when it came down, the next day, there was a green candle, means the buyers came in. So that's a bit of an indicator that, hey, there's buying. And then again here, when it got close, the next day, there was buying indicator. So of course, when you see buyers coming in, usually this is a good indicator to say, hey, I think the price is going to go up. But then honing in on the right entry and the right exit becomes important. So in the next video, I'll talk a bit more about, what to look for in terms of an entry, what to look for in terms of an exit. But for now, the takeaway is, what's the moving average? Well, the moving average is an indicator that helps you smooth out the price. It helps you identify a strategy basically to buy and sell. But before you use that strategy, there has to be certain conditions that are met. One, there has to be some sort of a trend that the stock is following, either a straight up or a downtrend, but there has to be a clear trend. It's not moving just sideways, you know? And then second, there has to be a pattern in the sense that you have to see that when the price gets back to the moving average, that it's reacting in a way. So when it comes back, it moves up on an uptrend, and on a downtrend, it could be the other way around. But for now, if we just focus on an uptrend, so there has to be a pattern that the stock has followed when it gets to the moving average, so that you can then say, okay, this pattern could repeat. And of course, for a pattern, my recommendation is, don't look at it that it just happened once. It has to have that pattern at least a couple of times, 2 or 3 times. So like, here it touched it, moved up, here it touched it, moved up, here it touched it, moved up. So it's done that a couple of times. And stay tuned for the next video, where we'll talk a little bit more on what are certain other ways to define an entry and an exit. And of course, like always, please keep in mind, this channel is really meant for learning. It is not financial advice. If you are trading, please do your own diligence and your own analysis.